Hey everyone, Richard here, and in this video today I'm going to share with you the difference between interest only and capital repayment mortgages. This is a question that I get asked a lot by my clients and on this channel. Like, people are always asking when they're looking at buying a property to add to their buy-to-let portfolio. They're always saying, like, should I buy it on an interest only mortgage or should I use capital repayment? So in order to answer the question, I thought I'd create a video on it, and in today's video I'm going to basically go through a worked example with you. And basically this is going to give you an insight into how I think about things when I'm scaling my property portfolio, and how these calculations and how I work out the numbers has enabled me to scale my property portfolio like in exponential time, and also like really safely as well, because every decision that I make is based on numerical data. Like, when I'm thinking about things as well, I'm always thinking about the long term instead of the short term. And this is something that I learned, actually. I learned this kind of philosophy from a really high level from Jeff Bezos. Like, my mentor, Sam Ovens, he got me to look at some letters from Jeff Bezos about like his shareholders letters that he had written. And he was basically saying in his shareholders letters, from a high level, that like he would take like a 9-year loss for a 10-year exponential growth. And so, like, we're not going to be making losses here in 9 years and then doing the 10-year exponential growth, but we are going to be thinking about long-term over short-term. And from working with a number of clients, I think, like, and certainly when I started, I didn't look at numbers how I look at them today. I think that everyone looks at things on more of a short-term numerical basis, when actually when we're making our decisions and answering questions like this, we really need to think about the long term, because ultimately when we're building a buy-to-let property portfolio, right, we're investing for the long term. Like, we're looking to build long-term sustainable wealth. So yeah, in the video I'm going to share with you a worked example. I'm going to show you how it works, and then we're going to summarize at the end, and hopefully it will give you an insight into not just how I make my decisions and how I've helped clients make their decisions to grow their portfolios, but also like answer the question for you and help you understand how to process the numbers and work out the answer to this question as well for yourselves. So for those of you who don't know me, my name is Richard Norris. I'm a successful property investor. I've built a multi-million-pound property portfolio. I do over 100K a month, and I've helped over 300 clients start and grow successful property portfolios too. So let's get into this worked example then. Now, if you haven't got a calculator, it might be worth just grabbing one, going through this video. You don't have to, but yeah, I would recommend it, because we're going to like go into the granular detail to help answer this question. So first and foremost, like, what is an interest-only mortgage? Well, an interest-only mortgage basically means that when you take out a mortgage, and typically as property investors, we take out mortgages for like 25 years, right? And that basically means that over the 25-year term of the mortgage, we're only paying the interest. We're not paying down that mortgage. So that mortgage stays exactly the same over the lifetime of its mortgage, over the 25 years. It doesn't get less, it doesn't get more, it just stays exactly the same as on the day that we took it out. And I'm going to explain that in more detail here with the numbers to substantiate that. And capital repayment basically means that over the 25 years, we pay off the whole debt. So over the 25 years, the mortgage balance will be cleared, and at the end of the 25-year mortgage term, we'll own a property with no mortgage on it. Now, whilst like the second one, paying down the mortgage over 25 years to zero, sounds like an attractive thing to do, and owning a property with no mortgage on seems like an attractive thing to do, there's a number of reasons why, as property investors and like myself, we choose to use interest-only mortgages over capital repayment mortgages to scale the portfolio. And that's a big point. Like, if you're looking to scale a portfolio, then interest-only mortgages is probably going to be a better option for you than over capital repayment, because if you go with capital repayment, you're really capping growth. And interest-only mortgages allow you to scale faster, quicker, and you're going to see the difference in the numbers, like just how big of a difference there is when you're looking to scale the portfolio. So let's jump into the example then and do some calculations. So let's say that we buy a property for £250,000. Now, in both examples, we're going to buy the property for the same price. Everything's going to stay the same, but we're going to choose to buy the property in two different ways. We're going to buy that property on interest only, and we're also going to buy it on a capital repayment mortgage. And I'm going to go through the calculations and show you the difference there. So £250,000, and also for the purpose of the calculation, I should say that we're not allowing any taxes. We're not taking into account taxes, and we're also not taking into account like your personal income, which is why we don't look at the taxes. And we're also gonna like not look at any other fees. So like in a property portfolio, when you're building a property portfolio and you're looking at numbers like this, you'd usually take into account management fees if you've got a management agent, and you'd usually take into account things like monthly operating expenses, which is basically the day-to-day running of the portfolio, right, for that specific property. You may pay gas, water, electric, council tax, depending on whether you're doing a HMO model or buy-to-let model, will depend on whether you actually have to pay those bills or whether the tenant pays it. But basically our MOE covers for things like maintenance, and just for any wear and tear throughout the year. We're not going to allow for those things. We're just going to allow for the rent minus the mortgage to give us our gross profit. And the reason that we're doing that in this video is so that it just makes the point. When you run the numbers from a high level like this, it will help you to make the point. It will help make it clear for everyone to follow as well. So £250,000 is what we're buying the property for. Now, typically speaking, when we buy a property as an investor, as a buy-to-let property, we put down a 25% deposit, and we take out a mortgage of 75%. So 250,000 times 75% gives us a mortgage of £187,500. And if we look at the difference between 250 and 187,500 pounds, we get the deposit and equity that we put into the property. So on day one, we buy this property, we put down 62,500 pounds of cash to buy this property as our deposit. And the mortgage is at 75% loan to value, okay? Now, let's say that this property rents out for £1,100 a month, right? And if we were to buy this property on an interest-only mortgage, and this is where you need your calculators, if we were to buy this property on an interest-only mortgage, we'd take 187,500, so the mortgage, and we'd times that by 3.5%. We're assuming as well, guys, for the purpose of this video, that we're buying the property in a limited company. And as of today, as of the recording of this video, interest rates in a limited company for buy-to-let mortgages are around 3 to 3.5%. So I'm going to use 3.5% in the example. So we take 187,500, we times that by 3.5%, which tells us the amount of interest that we have to pay on the £187,500 mortgage across the year. And then we divide that by 12 to get our monthly mortgage amount. So you can see here that if you do it on your calculators, that the answer to that is £546.87. So we're just going to round it up to the nearest whole. So the more interest-only mortgage is going to cost us £547 a month. Now, if we do 1,100, which is the rent, minus £547, we get a gross profit of £553 a month, and therefore an annual profit, if we times that by 12 to make it an annual, we get a gross profit of £6,636, right? So £6,636 is our annual profit. Now, to work out the return, what is the return that we get on this property? We take the £6,636, okay, and we divide that by the deposit, the money that we put in, which is 62,500. So we divide 6636 divided by 62,500 times 100 to turn it into a percentage. It basically means that on this particular purchase, if we were to buy it like this, we'd get a 10.6% return, okay, on our investment. Now, if we look at this as a repayment, a capital repayment, we'll see that the profit that we make will be a lot lower. So if we're to buy this property, the same property on a capital repayment mortgage, we'd actually get this. So we'd get the rent at 1,100, so the rent stays the same. But on the mortgage, we do £187,500. Now, I have a mortgage calculator app here, and so I'm just going to do it in here. So we take £187,500 over a repayment period of 25 years, okay? At an interest rate of 3.5%, gives me a monthly repayment here. Oh, sorry, you can't see it, so my bad. It gives you a monthly repayment of £948 and 3 pence, okay? So for this example, we're going to say it's just £948 to the nearest whole, okay? Now, if we take the 1,100, okay, so the £1,100, and we minus off, so 1,100 minus off the £948, gives us a gross profit in this example of just £152 a month. So you can see like it's a lot less. So in the first example on interest only, we're making £553 a month of net cash flow. But if we just do it on a repayment mortgage, then we're making £152 a month. So we're making less money. But if we take the £152 and times that by 12 to give us our annual return, that gives us an income of £1,824, right? Gross. Now, if we take the 1,824 and we divide that by the £62,500 deposit and we times it by 100, we get a return on our investment of just 2.9%. Okay, so you can see that it's nearly like 7% lower, like 7 to 8% lower that we make as a return. So then what we do, like, well, okay, this makes sense. Like, obviously we're making more money, we're making more cash flow. But some people might say, well, you're making more cash flow in the first example on interest only, and on a capital repayment, you're making less cash flow, but you're repaying down the mortgage in the second example. So you're making less cash flow, but you're paying down the debt. And, they might, and they're right to assume that. But what we need to take into account is looking at the long term. And this is where the calculations really start to help us make our decision. From a high level, it makes like complete sense. Like, it's just like, okay, well, one makes us 6,636, the other one makes us 1,824. But that's only the start. Like, when we start to get into this now in the second set of calculations, like, you're really going to see how this starts to compound and how I make my decisions. So if we take the difference, then let's actually work this out. 10.6, right, minus 2.9 means, 10.6 minus 2.9 means that we make in this example, in the first property on interest only, we make an additional 7% per year, right? Now, if we take the 7.7% and we times that by 25 years, because that's how long we're going to be growing the property portfolio for, holding this property for, based on this example of having a mortgage of 25 years, 7.7 times 25 years equals 192.5. So effectively, over the 25 years, you're making a 192.5% bigger return if you buy this property on interest only versus capital repayment, right? But it still doesn't, it's not the full equation right now. At the moment, it only looks at one variable, which is the cash flow. But what we really need to look at to make a like-for-like comparable is like, well, with the additional £6,000 that we're making in the first example, as opposed to the £1,824, what do we do with that money, like the £6,000? Now, as a property investor, what we typically do is we'd reinvest that £6,000 every year. We'd save the money up to buy more properties and put down as more deposits. And you can see that if we had 6,000 to do that with a year over 1,824, you can see that on interest only, we're going to be able to do that and facilitate that a lot faster. Which is, again, one of the reasons why I choose to use interest-only mortgages to scale my property portfolio over repayment, because repayment really doesn't allow me to bulk that much. And when I go through my business, I go through periods of bulk and then debt consolidation, bulk, then debt consolidation. I kind of like to use the example of the person that goes to the gym. The person that goes to the gym and wants to bulk up and get really big, they go through phases of bulking and then cutting, and they kind of strip away the fat in their cutting periods. And as a property investor, it's kind of like the same thing we need to do if we want to grow and scale. We bulk, then we cut. We bulk, then we cut. And that's the approach I use. So let's take a look at this then, between like what happens if we were to really bring this into life, and to look at the calculation over 25 years. So in order to do that, what we do is we take the £6,636 and we minus off the £1,824, right? And if we take 6,636 minus the 1,824, we're left with an extra £4,812 a year, okay, in the first example, if we did interest only versus repayment. And then if we take that £4,812, right, and then we times that by 75%, sorry, not 75%, 25 years, £4,812 times 25 years gives us, gives us an additional £120,300 of cash, right, to invest, versus if we're to use capital repayment, right? So you might be thinking, well, okay, that's good, but how does it actually work in terms of we're making an extra £120,300 in cash flow over the next 25 years, but we've still got a property in the first example where we've got debt. And in the second example where we're doing capital repayment, we've got a property with no debt. So let's take a look at that then. So if you brought this, I'm going to do number one here, right? I'm going to actually put like number one here, and I'm going to put capital repayment, okay? CR means capital repayment. So if we're to buy this one property for £250,000, so this one property here, right, for £250,000, so 250k, right? And all we were to do is invest in this one property, buy it for £250,000, put a capital repayment mortgage on it. So over the 25 years, we have zero debt on this property. So over the 25 years, we've paid the property down. And let's say in this example, in 25 years time, that this property is worth 500k. So it's gone up 250k in growth. So we've gained on capital growth, right? We've made another £250,000 in capital growth. And that's great. And we have no mortgage on it. So the equity in this position means that in 25 years time, we have a property with 500k of equity in it. Okay. And in this example, remember the rent was £1,100 and we have no mortgage now, right? So at this point, we've owned the property for 25 years, we've paid it down, and we've got capital growth of £250,000. Now we take the £1,100 and then we times that 1,100, right? So we take the 1,100 and we times that by 12, which is £13,200. So times this by 12 equals £13,200, right? That's what we're making a year. So if we did example one, capital repayment, we own one property at the end of 25 years that has £500,000 of cash equity in it, which is our money. We paid off the mortgage and we make £13,200 a year in annual cash flow, right? And that's great. But what happens if that we actually did this in another way? So if we actually brought it interest only. So in interest only, remember up here, we had this one property that was making £6,636 a year, right? Now, over the 25 years, if we're making £6,636 over 25 years, if we choose to reinvest this capital, effectively, in this example, I'm going to say that we're going to buy properties for £100,000. So every property that we buy for £100,000 over the next 25 years is going to need a £25,000 deposit, right? But if we include purchase costs, we're roughly going to need £30,000 every time we buy a property. So effectively, this is saying that in every 5 years, we accumulate £6,636 times 5. Every 5 years, we have another £31,180 saved up as a deposit, right, to put down and buy another purchase from the same initial purchase, right? So this is, we're reinvesting the profits from the very first property that we brought up here for £250,000 on interest only, okay? So in this example then, effectively, if we've got 5 years, every 5 years we can buy a new property. Over the 25-year period, we can actually buy an additional 5 properties using an interest-only mortgage strategy, right? So we end up with 5 properties, right? So we buy another 5 properties, right? Put 5 properties here. 4, 5. So we buy another 5 properties that we add to our portfolio. And each of these properties is worth 100k, has a mortgage on it of 75k, okay? So just multiply this out. Okay. Now, let's assume for the purpose of this example that all of these properties make us £300 of net cash flow a month. So 300 times 12 is an additional £3,600 a year. Now, if each of these properties makes us £300 a month and an additional £3,600 a year, at the end of 25 years, comparing it to example 1, we will own 5 properties of £3,600, an additional 5 properties, all making us £3,600 a year. If we take that £3,600 and we times that by 5, that means that we're making an additional £18,000 a year of net cash flow in example 2 buying on interest only, because we can buy another 5 properties with the accumulated profit, right? By reinvesting. So in this example, we'd end up with the first property that we bought. So we end up with the first property that we bought. Now, the first property we bought, remember, we bought it interest only, and it had £187,500 of debt on it, and it was initially worth 250k. But we're saying in this example that this property doubled over the 25 years, and therefore it doubled in value to 500k, exactly as example number 1 where we bought it capital repayment, right? But at the end of it, we had no mortgage, and it was making us 1,100 a month, 13,800. Sorry, it was making us 13,200 a year here. Look, okay. And in example 2, we now own this property, and unlike the first property where this property had no mortgage left, this property does have debt. So the debt on it remained the same. At the end of the 25 years, we still owe £187,500. We've only been paying the interest off. But this property now has £500,000 equity because it's gone up. Sorry, £500,000 is the new value, not equity. So the new value of the property is £500,000. If we minus off the mortgage of £187,500, we are left with equity in here of £312,500, okay? Whereas in example 1, we had £500,000 of equity because it was on a capital repayment and we paid the mortgage off. However, this property is still making us £6,636 a year, right? Assuming that the rent hasn't gone up and the mortgage interest hasn't changed over the lifetime, okay? Just for the purposes of the example and to make this calculation straightforward for people to understand and help them answer the question whether it should be repayment or interest only. But in this example, rather than having one property that we own with £500,000 of cash in it making us 13,200 a year, we've actually got the first property we bought, which is £6,636 of net cash flow a year, 312.5 equity, but we also have an additional 5 properties, right, that are also making 18,000 a year, right? Now, if we add the £6,636 to the additional £18,000 of net cash flow from buying the 5 properties over the 25-year period, we end up with a cash flow in this example of 18,000 times by 6,636. Sorry, 18,000 plus 6,636. Which equals £24,636 a year, right? And in the previous example, we were only making 13,200 a year by buying on capital repayment, and we only owned one property at the end of it, right? Now, so the difference is 24,636 minus your 13,200 means in this example, in 25 years' time, if we used an interest-only strategy to build our portfolio and get to 6 properties in 25 years versus the person that bought this property on a capital repayment and owns 1 property in 25 years with no debt, then the difference is we make an additional £11,436 a year at the 25-year mark, right? So not only is it better on that way, but we've now got another 5 properties in our portfolio, and all of these 5 properties are all going up in value as well. So let's assume, just for the purpose of this example, and I know that, we've got an additional 5 properties here, and that this one is at the 25-year mark. So we can't allow capital growth on the 5th property we buy, because at the 25-year mark, we've only just bought it. So there's going to be no capital growth on that one. So there's only 25k of equity in this one. But let's just assume, for the purpose of this working example, to make it easy to understand, that all of these properties, and it's very likely because we're buying this one at the 15-year mark, right, and this one at the 25-year mark. So especially on the first 3, they would definitely say double over the 25 years, and this one would maybe double over the 10-year mark. But to keep things easy, we're going to say that all of these properties doubled in value, right? So they all went up to 200k, right? Okay, apart from the last one because we bought that at the year 25. So in this example, we end up with an extra £100,000 of capital growth in each property, right? So in each of the 4 properties, we get an extra 100k capital growth. The last property, because we buy at year 25, we're assuming no capital growth, right? So that's an additional £400,000 of capital growth. 100,000 times 4 is an additional £400,000 of capital growth over example 1, buying on repayment in example 1. By buying on interest only, we end up with an additional £400,000 of capital growth across the additional 5 properties. And in each property, we have £200,000 value against a £75,000 mortgage. So we end up with a position where we've got 125k of equity across each of those 4 properties as well. So 125,000 times 4 is I think it's 650. Just double check. 125,000 times 4 equals 500. Sorry. So we end up with an additional. We end up with 500k of equity in the first 4 and 25k of equity in the final one, which is 525k of equity across the 5 properties. So let's summarize then. So in example 1, right, where we brought on capital repayment. So just rub that out. We brought on capital repayment. So example 1, capital repayment. These are the results. We had one property. So one property that had £500,000 of equity in it, because that's what it was worth. Okay, and it was making us 13,200 a year in net cash flow, right? Just double check that. So in property 1, 13,200 here, right? Okay, and that was the results of buying on capital repayment. One property, £500,000 of equity and 13,200 a year of cash flow. But in example 2, we ended up with 6 properties, right? 6 properties over the 25 years, and both of these are over 25 years, right? So 6 properties over 25 years versus the 1 property. Now, in the 6 properties, the total equity across the properties was, what did we have here? So we had the first property up here that had, where are we? So the first property here. So the first property here had 312.5k of equity. Okay. So we take £312,500 of equity, plus we take the equity from these 5 properties that we brought additionally. And in these 5 properties, we had £500,000 of £525,000 of equity across those 5. So we have one at 312,500, sorry, in one, property number 1, and we have another £525,000 of equity across the other 5, right? So if we take the 312,500 plus 525,000, we end up with a position where we have £837,500 of equity, right? So that's an additional, if we take the 837,500 minus the 500,000 from the first, if we're comparing results versus the buying on capital repayment, we end up with an additional £337,500 of equity, right? And we end up with 6 properties that pay us an annual cash flow of £24,636 a year. 24,636 a year. Okay. And if we look at what we had in the first example, we had 13,200 a year cash flow, which again, remember, by buying on interest only and leveraging, we're making an extra 11,436 a year. Okay. So we're up £11,436 a year. Okay. So the overall gain is this. We have an additional 337,500 of equity, right? We have an additional £11,436 of cash flow every year. And in terms of capital growth, on the capital growth side, we made on property number 1, we made a capital growth of 250. So we had 250 plus we had 400,000 of capital growth by buying the 5 properties. So 400 plus 250 we ended up with £650,000 of capital growth. And we take the £650,000 of capital growth minus the £250,000 of capital growth that we got from buying property number one, we end up with an additional capital growth of 400,000 by leveraging. Should say capital growth there. So the results. So 337,500 equity, £11,436 of cash flow, and £400,000 of capital gain. So you can see that obviously in this example, like interest only versus repayment, like if you look over the long term at scaling a property business, like using interest only mortgages to leverage your portfolio and scale, you're going to make exponential gains as opposed to if you just buy properties on repayment. So that's why myself and my clients who want to grow multi-million-pound property portfolios use leverage and use interest-only mortgages versus capital repayment. There's a whole host of other reasons why we use interest-only mortgages, such as like it's really good to die with debt for inheritance tax planning and stuff. But I have separate videos in my property tax section in the channel that talk about all of these things. So I'm not going to go into that on this video, but if you want to understand why buying properties on interest-only mortgages and basically having debt when you die is a good thing, then check out some of the videos in the property tax section on my channel. So yeah, so you basically understand that, you know, that's the best way to buy property if you want to leverage is interest-only mortgages. With that being said, if you're somebody who wants to pay your mortgages down to zero, that's also okay. You're not going to get as good returns. But if you don't need the cash flow for whatever reason, and you just want to end your working life, like let's say it's a pension strategy, and you love your corporate job and you want to carry on in corporate, and you just want to use property as an extra passive income vehicle, and all you want to use that portfolio for is to top up your pension at the end of your working life, and you're somebody who's got it in their mindset that at the end of my working life, I want to retire with a pension from my corporate job, plus I want to own properties that have no debt on them, then capital repayment would work for you, but you're going to make a lot less returns on your money than if you were to still use leverage in that position, use interest-only mortgages. But yeah, for me, this is how I make my decisions. This is how I do the math. This is how I run the calculations. So I hope it helps you make a decision for you, whether interest-only or repayment's better for you. But like I say, if you're wanting to scale a multi-million-pound property portfolio, or even if you wanted to get to 10, 15, 20 properties and grow a portfolio and you're just starting out, then I think interest-only mortgages is going to be a good thing for you. And personally, in my opinion, interest-only mortgages is the better way to approach your property portfolio and scaling. So yeah, hopefully you enjoyed the video. If you did, please give it a like, hit that like button. It really helps us to get more views, and it helps us to get more people watching our videos, which is really helpful. So yeah, I'd really appreciate it if you hit the like button. If you didn't like the video, I love you anyway. That's also okay. And guys, let me know in the comment section, if you have any questions. I know that sometimes, when I first did this and it was the first time going through the calculations, yeah, I didn't understand it immediately. So don't worry if you're watching this video and you don't understand all the calculations right now. It's quite a complex calculation. Just watch the video again. Just watch it as many times as you need to understand it. But equally, if you're still struggling, just drop a comment in the comment section below. Just put a question in there. Ask any question you like. If you need any clarity on any points in this calculation, just put areas that you want to clarify. Myself or one of my team members will come in and answer those questions for you so that you understand everything about these calculations and so that you can make the right decisions for you. So the last thing to say is as well, if you haven't subscribed already to my channel, hit that subscribe button, and also hit that bell icon, because it will help you get notifications. We upload multiple videos a week, and so if you want to get reminders as to when the new videos come out and be notified, then click the bell icon and you'll be notified for new content. So thanks for watching the video. Like I say, I hope it helped. I hope you found it useful. Be resilient, be great. I believe in you, and I'll see you in the next video.